Good morning, everybody. Thank you for joining our webinar today. Who cares about 401k? This is a RingCentral webinar and audio has been muted for all attendees. Please use the Q&A button at the bottom of your RingCentral window to submit any questions. You can submit questions throughout the presentation, but we are going to hold a Q&A session at the end to address all of those questions. If we don't get to address your question today on the webinar, we will actually reach out to you directly and follow up with the answer to your question. Please don't worry about taking notes today. We are going to be sending this presentation out probably tomorrow morning with a thank you note for attending. So don't worry about taking a lot of notes today. This webinar has been approved for 1 professional development credit for your SHRM recertifications. The SHRM activity ID number will be provided at the end of the presentation when we start the Q&A session. So I'd encourage you to jot that down at that time. My name is Terry Ackerman. I lead the HR technology and human capital consulting team here at the Encompass Group. We are joined by our partners from VisionPoint and the Finway Group. And we started this partnership years ago. The Encompass Group was looking for a better 401k solution. And so we partnered with VisionPoint and the Finway Group. And working together, what we were able to do is create automation and streamline processes, reduce fiduciary responsibility and liability, and really focus on employee education and communication. It's a really important piece as well. That's really what we were looking to solve for when we partnered with VisionPoint and the Finway Group. Once we implemented it for ourselves and perfected it, we said, hey, this aligns with our vision, mission, and core values and what we want to provide to our clients. So then we made it available to our clients. And we've been doing that over the course of the last year or so. And we hope that others are interested in what we've put together because it does provide a lot of great benefits. You'll get to hear from different members today from our 401k partnership. Jacinta Thompson with VisionPoint will provide an overview of the provisions of the CARES Act and ramifications of what you do today post-COVID-19. And then Steve Finnegan with the Finway Group will discuss operations and communications as it relates to the CARES Act, and will also provide some insight on how to leverage technology to your advantage. And then we'll wrap up today's webinar with Jim Warner providing a quick market overview, a coronavirus update, and some thoughts on the impact to our economy. So at this time, I'm actually going to turn it over to Jacinta with VisionPoint to cover the CARES Act.
Thank you. As mentioned, I'm Jacinta Thompson, and I serve our clients as a part of the retirement plan consulting team at VisionPoint. Today, I'm going to touch briefly on the CARES Act, but more importantly, on the post-COVID-19 issues I think we should be concerned about. Let's start with hardship and in-service withdrawals. Your plan must already allow for these types of withdrawals or be amended for this type of withdrawal to be able to fully adopt the CARES Act. Standard hardship provisions will continue if you do offer them, regardless of whether or not your employee or your plan is adopting the CARES Act. Meaning your employees will still have access to funds if they need it in these emergency times. To be an eligible participant, you have to have been diagnosed with COVID-19 via a CDC-approved test or have a spouse or dependent who is diagnosed. Additionally, if you are anyone who has experienced adverse financial consequences due to the quarantine, furlough, a layoff, reduction in hours, or an inability to work, simply due to the coronavirus and childcare being unavailable, you too would qualify. This makes it pretty wide open for participants to gain access, which is a concern we have. Plan sponsors, luckily, unlike hardship withdrawals and how they're being processed today, can rely on participant certification for these qualifications, making this a much easier thing to navigate. Let's focus first on the in-service withdrawal provision. The distributions that are going to be allowed through the CARES Act do allow participants access to up to $100,000 worth of their vested account balance. These distributions may be repaid in lump sums or installment payments over the next 3 years, which is unique to most withdrawal provisions. In addition, for any participant who is under the age of 59 and a half, the 10% IRS penalty for early withdrawal is going to be waived. Participants will also have the ability to spread this tax consequence out over the next 3 years. And last but not least, this provision and all CARES Act provisions with regards to the 401k do expire on 12/31 of this year. Next, let's talk about participant loans. Again, similar to the in-service and hardship withdrawal provision, your plan has to already be offering plan loans for you to take advantage of this portion of the CARES Act. If not, you can choose to amend your plan to allow them so that you can utilize this benefit. Currently, plan loans or participants are limited to withdrawing no more than $50,000 or 50% of their vested account balance. The CARES Act, in effect, doubles those limits. It will allow participants to withdraw $100,000 or 100% of their vested account balance, whichever is less. That began on March 27th, assuming you had already adopted the CARES Act, and will expire 180 days later, which is roughly September, I believe, the 21st of this year. Loan payments on those types of loans are not going to be required for the first full year. Additionally, you may have plan participants who already have loans outstanding today that may need some assistance or, shall I say, some grace on paying those loans. That said, the CARES Act will allow those employees to go ahead and defer those payments for the next year, beginning those payments again after January 1. Steve will talk to you a little bit about the important process you'll need to go through for those plan participants once this is over. During that deferred period, their interest will continue to accrue. However, the 5-year period of the loan is simply pushed out 1 year. The same eligibility requirements for the loans are the same as I outlined for the hardship and in-service withdrawal provisions. And this too is a participant certification process, so no necessary action on your part. Required minimum distributions is the last thing I'll talk about with regards to the CARES Act provisions and how it impacts your 401k. For those of you that may not be familiar, a required minimum distribution is a distribution that has to be taken for anyone who no longer works for your organization or who may work for your organization and is a 5% owner or more once they reach the age of 72. These generally are not administered by HR professionals or anyone at your organization, but it's a good thing to be aware of. At any rate, the CARES Act is allowing participants to go ahead and waive this required minimum distribution for this plan year, allowing them to take advantage of leaving that money invested in the market and not having to take it out during depreciated market times. The rollout of this CARES Act has really been embraced in a variety of different ways across record keepers and TPAs. Everyone is working diligently to be sure that plan participants have access to these provisions in the best way they know how. Some record keepers have gone ahead and given a deadline and said if you do not opt out of the CARES Act by a specific date and time, they will go ahead and opt you in. Other vendors are requiring some sort of affirmative action by their plan sponsors to opt in or out of this provision. Last, we do see some of our record keeping and TPA partners embracing this a little bit differently and allowing plan sponsors the flexibility to customize their approach somewhat, maybe allowing participants a little lesser access to their retirement assets, but still allowing them to embrace some of the tax preferential treatment of these types of withdrawals. I really want us to start thinking or shifting our view, if you will, to the long-term impact of COVID-19. First and foremost, we've seen plan sponsors experiencing partial plan terminations due to the reductions in force that we've seen during these times. If you're not familiar with a partial plan termination, this is something that occurs naturally if you've experienced a reduction in force of 20% or more during a plan year. If in fact that does happen, those employees that were impacted by that reduction in force do become 100% vested immediately. While that might not have an immediate financial impact on you today, you do need to be looking into whether or not this has occurred on your plan, as these forfeiture dollars that you may be using to offset your current and future employer contributions may be getting spent when they need to be paid back to these plan participants if a partial plan termination were to occur. If you have not heard from your record-keeping partner or your financial advisory partner, I would encourage you to reach out to them and ask where you stand in this calculation so that you can be best prepared. Additionally, we need to be mindful of the fact that record keepers generally have an equation that they're utilizing when they calculate your plan cost. Plan cost generally circulates around 3 different pieces. The first being assets under management, the second being number of active lives they're record keeping, and the third being the average account balance. All 3 of these have been dramatically impacted for many of our clients during times like this. Especially if we see a partial plan termination take effect, we need to be cognizant of the fact that that could impact your overall record keeping costs. This is something we should be aware of. I would say last, but certainly not least, most of us would agree that our employees are our most valued asset. If that's the case, we really need to be concerned about how they're handling their financial situation during these times. I have spoken to hundreds of participants who have called with questions around, I've already sold out of my investments. What else can I do to protect myself? Or participants who've taken withdrawals via the CARES Act or otherwise from their accounts thinking it was their best approach to protecting their assets, leaving these participants to start at ground zero when this is all over. VisionPoint truly believes at times like this, education is especially essential. We have already begun thinking forward to how we need to help these participants and meet them where they are. First and foremost, we're putting together a series of short recorded messages for you as plan sponsors, but also for their participants that address things like tax strategies. With the different tax ramifications of the CARES Act and other withdrawals that are being taken at this time, participants are beginning to ask the questions, how can I best take advantage or protect myself with regards to the tax consequences of things that I've done during this period of time? When referred back to their tax specialist, many times we hear participants say, yeah, but I do my own taxes. How can you help? We've embraced this. We've heard our participants loud and clear, and we're reaching out to our tax partners as one of the partners to put together a message for plans participants to answer some of those questions. In addition, for most of us, this is a long-term investment strategy, and the pain we're feeling today will hopefully be a short-term pain. And while for many plan participants, this is the first time they've experienced substantial loss in their 401k plan, we need to remind them of the core investment concepts of rebalancing during times like this, dollar cost averaging, and keeping the long-term in perspective. And last but not least, we've got to help them get their savings back on track. And the focus can't solely be on the 401k plan. Education has to be much more broad. As you, being leaders in your organization, are having conversations about how you're going to pull your organization out of this crisis that we're all going through currently, participants are having similar conversations in their own homes. How are we going to recover from this financial impact we've seen? We want to be there to help all of our plan sponsors and their participants as they begin to recover from this. I thank you for your time, and I'm going to go ahead and turn this over to Steve, who's going to talk about plan administration.
Thank you, Jacinta. I really appreciate that. And I run a company called the Finway Group, and we do compliance administration, plan documents, tax return, and as you'll see, we kind of also operate and run plans for many of our clients. But I think it's important that we kind of, as we step back and look at the great information that Jacinta shared with us, and that at the end of the day, this does put some burden and responsibility on you folks that are the plan administrators or plan sponsors of of your retirement plans. So it's important that you respond to your record keepers regarding the CARE Act. As Jacinta mentioned, some of them have already defaulted you in or defaulted you out, and you may or may not have you may have missed that email notification of your election time frame. So I encourage you to, after your presentation today, is reach out and say, where are we and what have we done with the elections upon the CARE Act? We talk about those limits of hardships. We talk about the limits of loans. As Jacinta mentioned, there are $100,000 we can go to hardships, $100,000 we can go to loans. But keep in mind, you don't have to. You can still elect the CARE Act and choose lower limits. You can choose the CARE Act and say, I'm going to do the CARE Act, but I don't want my limits to be 100. I want them to be 50. Or I don't want to raise my loan amount to 100. I want to leave it at 50, but allow them to take 100%. So you do have discretion. You do have input. And I encourage you to discuss this with your advisors, your administrators, and your record keepers so that you're putting the best foot forward as far as what you feel is right for your plan and your participants. Secondly, is you may need to amend your plan now. If you currently do not offer loans or offer hardships, and you are electing the CARE Act, you will need to amend your plan now. There's future amendment coming for the CARE Act clarification and definitions, but you'll need to establish current loan processes and procedures and hardship procedures if you're embracing and adopting the CARE Act if you currently do not offer those in your plan. The other thing that's impacting a lot of our clients today is they currently have a match. They may have a stated match in their documentation, in their plan document, or also they may be making a safe harbor contributions. So if you're having a discretionary contribution to your 401k and you want to suspend it, we encourage you to just notify your employees that you're going to be suspending it for a time period and that you may be reinstating it later. And there's no requirements if you truly have discretionary match features in your plan document. If you have a stated match and you need to suspend those matches, you will need to amend that match and you will need to send out some notification to all participants that you are suspending a stated match within your retirement plan. Lastly, for those of you that may be suffering some financial consequences for this, the COVID virus, that have a safe harbor plan, those contributions can also be frozen. They can be frozen now and suspended for a time period. The rules are set that if you want to keep your safe harbor status for the year, you need to restart your safe harbor contributions by the quarter following the month that you suspended your safe harbor contributions. So if you were to do it today, you will have until the end of September to restart safe harbor contributions back up. You'll have to pay back contributions that you've missed, but that'll maintain your status for the year on your safe harbor contributions, but give you a little bit of freedom and breathing room during this uncertain time as to whether you're going to be able to maintain those safe harbor contributions to your plan. Lastly, if you don't make those contributions, then your plan will be subject to regular testing requirements of what we call average deferral percentage and average compensation. So your administration would know that. Again, please reach out to your record keepers or your administrators or your advisors and address that situation if that applies to you. Jacinta had mentioned talking about the loan suspension of existing loans or even new loans that can be done for a period of 12 months or less, that could extend as far as 12 months. This responsibility is the responsibility of the plan sponsor who is overseeing payroll. You'll have to adopt the CARES Act to allow loans, to ultimately allow suspensions, but then it's the plan sponsor, plan administrative responsibility that's overseeing the payroll to notify the record keeper that those loans are being suspended so that it can be tracked electronically online. It's also your responsibility, a plan sponsor or administrator, to note them when they come back to work, if they were a temporary layoff or a furlough. So there's some communication things that I would encourage you to embrace, and working with your record keepers to know exactly how to communicate that to them. Loans will be re-amortized once they come back and the suspension period is over. As Jacinta mentioned, they'll continue to accrue interest, but at least the loans will be suspended until they start back, and it'll be re-amortized over the balance of the loan. The other thing to just be aware of is operationally is some retirement record keepers out there automatically force out terminated employees with low balances. They could force them out at 1,000 below. They could put them into safe harbor IRAs if they're between 1 and 5, or they're going to notify employees if they have larger balances now that they're terminated to get out of the plan or transfer their money. If these are temporary layoffs, or these are furloughs, or these are terminated employees just to help get unemployment to get these folks back, you may want to, again, talk to your record keepers, talk to your advisor that says, you know what, maybe we should suspend forcing people out for now, because again, we don't want them to have to start all over. We don't want to have to send them a check and get it out of our plan. So again, I think it's important to think about this option, maybe breathe for a little while and let some time pass and the dust settle before we aggressively start pushing terminated employees out of our plan. Lastly, these care amendment acts only apply to, as Jacinta said, to the end of 2020. So a lot of this is temporary, we're going to have access to, and then we'll go back to the current way of actually running and operating your plan. So next, we want to talk about the anxiety of operations. And we talked about a lot of responsibilities that you have on the previous slide. And, what should I be doing? And, really staying up with all these changes. We have the Secure Care Act, we have the Secure Act, the CARE Act. We're soon to have interim amendments that are going to be coming out. We're certainly got reinstatement that's coming about next year for every adoption agreement. We've got notices that have to be required that are mailed out every year. And again, it's just, I'm not sure what I should be doing. I need to track eligibility. I need to make sure that everybody gets into the plan. I mean, tracking eligibility is the #2 violation that's been reported to the Department of Labor. My employer didn't get me in when I was supposed to get in. And there's penalties and corrections that have to be done if there's matches that were missed. So this is the #2 reason. #1 reason is not making your deposits on a timely manner. But the second reason is making sure employees get in a timely fashion. The other heartburn that we're seeing out there of things to do is, are my forms current? Do I have a current enrollment form? Do they have the current Morningstar data? Are my fee disclosures up to date? Has there been any changes? Do I have a plan highlights, the current recent plan highlights, as far as explaining to our employees, because we did an amendment last year. And so is everything up to date? And I'm constantly monitoring that to make sure that that's being communicated correctly. Last thing, another thing is approving loans, distributions. I have to review them. I get these emails that say I have to check on and make sure that they're approved or distributed, and hardships are the worst. We have to document a process of the reasons that they are now are approved for hardships. And sometimes you have to be the bad guy to say no. Now with the CARE Act, that's going to be changed a little different because there's self-authentication by the participant. But under the old rules of hardships, you had to verify and monitor and track everything that was being submitted. And again, what else? I get all these emails from my record keeper. Some of them I'm supposed to do something, some of them I don't need to do anything, and some of it's daunting. And so I may miss something that I should have done or mailed out or checked a box. And so that's, again, another distraction of things that you just don't know about this flood of emails that we get. Secondly, towards the end, we talk about I don't know what I don't know. As operators, we think that our advisors are fiduciaries. We think our record keepers may be, our TPAs may be, and in your situations, maybe none of them are. And you're out there on an island by yourself managing this. So, if you don't know what you don't know, it can hurt you because there are things that can be missed. And also, if you don't know that you've been auto-enrolled into the CARE Act, your employees may already have access to these hardships or these loans, and you aren't even aware of it because, again, you may have missed an email from one of your record keepers. So at least reach out, make sure that what is the status, where are we, and what do we need to do to prepare for this in the upcoming weeks. And then at the end of the day, did I miss anything? Is there something that I should have done that I didn't send out or forgot to do? And that's really part of the daily anxiety of operations. And so one of the major differences of the partnership that we have at the Encompass Group is technology. And all the data today that is necessary to run and operate your plan obviously sits inside your payroll information. So data is king. That information sitting there helps you run your plan efficiently. And all of those are sitting out there in those records. And so you can have simultaneous payroll records uploaded every pay period. You could have automatic notices to employees. You can have automatic notices to terminated employees. You can have immediate updates through deferral changes that are done electronically online by your participants rather than a sticky note. And there's always updated addresses when you're working within the Encompass system. And I think that's what's unique about the connectivity and the technology between administrators and the payroll and the record keepers is there's really no human intervention. It's all can be done and tracked electronically and done efficiently through communications. And, Terry, I'd like you to maybe weigh in on your experience with the Encompass Group on some of the technology leveraging points that are part of this solution.
Absolutely. We use a payroll platform called Exponent HR. It's a very strong partnership that we have. We actually offer Exponent HR to our clients as well. And the great thing about the system is it's all built around self-service. So the address changes are being made by employees. Employees are updating their deferral elections in the payroll system. All those things that employees are touching and making updates to, I don't have to provide that information to the bookkeeper because we have an integration. So after each payroll, the information flows over from Exponent HR to our bookkeeper with no intervention by myself. I actually oversee the 401k plan at the Encompass Group. So I can attest that all the things that Steve outlined here, I don't touch and I don't have to provide any information on because it's already flowing. The only things that we get involved in are kind of some of the year-end activities, which with the solution that we have with the Finway Group and VisionPoint, it's very minimal. So I can attest that there is hardly any human intervention with the solution that we have in place and with partnered with VisionPoint and the Finway Group.
Great. Thank you, Terry. So, this level of coverage or a level of support within your plan is called plan administration. And then it's an IRS code under 316, and there's an IRS code under plan fiduciary. And so there is an opportunity with our partnership to be able to outsource this because this is operationally things that may help you free up time, may help you free up resources, may help you cross-check and double-check so that mistakes don't happen. We have the ability to stop those daunting emails that are coming from your record keeper that continue to interrupt your day and are concerned whether I should respond to these or distribute these, or is this the latest form? We also, when you're talking about outsourcing, there's a documented process that the Department of Labor says you are required to go through, and that is date stamping. And that is documenting that you've sent out notices to eligibility. That's triggering for auto enrollments if you have an auto enrollment plan. And so there's processes in place that have to be done for you to make sure that everything, all the T's are crossed and the I's are dotted. By doing this, we share fiduciary liability responsibility. When we sign on as 316 plan administrator, we are signing on for liability and responsibility of operationally in the plan. Secondly, when we do that, we're required by law, by ERISA, that we also have to sign on as a plan fiduciary, which holds the same responsibility, liability, and oversight of the employer who is sponsoring the plan. So it's someone else that's standing there shoulder to shoulder that operates plans on a daily basis and helps you make sure we're, again, doing everything that's necessary and required by the Department of Labor. One of the critical things that we've seen with our relationship is that we also have a call center here where we have a single point of contact for all of our clients, whether it be the plan sponsor of having issue with forms or uploads or communication or response or changes, including participants. I need a form, I need a distribution, I need how to log in, I need a password. So we set up as a single point of contact, so it's simplification for you and your employees so that there's no confusion, no chasing 800 numbers, and it's also really important to them to be able to get an answer quickly and have a rep that actually works directly with you. The other thing of outsourcing, and Terry alluded to this, and that's the data exchange. As we continue to get data exchanged on a per pay period, We also, with the Encompass Group and the technology they provide, is we get the year-end census from them. And it's an extraction of the payroll summary and the W-3s, and it's really an incredible time saver for those of you that are in the administrative or HR role that have to do this work at the very end. So we talk about, the outsourcing, and it's really about time and making sure that we're doing what we need to do. And again, covering those things that if we don't know, are we getting them done? The key benefits of outsourcing, again, as I mentioned earlier, is we sign on in the adoption agreement legally under ERISA as the plan administrator. We also sign on as the plan fiduciary in your adoption agreement. So again, it's skin in the game. We're actually putting our reputation and our support and our financials behind making sure that your plan is being run in guidance with ERISA, the Department of Labor, and the IRS. We are the ones tracking eligibility, mailing out enrollment forms, SPD, fee disclosure, plan highlights. We're the ones that are mailing out SARs. We're the ones that are mailing out safe harbor, QDI, fee disclosure notices. And we're documenting it, and we're tracking it, and we're date stamping it. And so again, that's part of the CYA that's crazy in our world that we continue to have to monitor and do. But again, we're going to oversee the daily operations. We get a weekly email from our record keepers on a to-do list of things that we need to notify for a loan or a distribution or a payroll change or there's an issue going on out there. So we're weekly getting updates from the record keepers as to how we operationally need to manage your plan. And it's all been documented. We now, because of being a plan administrator, we can approve loans, we can approve distributions, we can approve hardships and monitor those and actually take you out of the mix for that responsibility and oversight as well. One of the other roles that I take on as plan administrator for our clients and the Encompass Group is fund reviews. That's again part of your job today as the plan sponsor administrator, is making sure that we have good funds that are available. And so I meet quarterly with advisors of like the VisionPoint as we look at the solution here for the Encompass Group clients to make sure we have great funds and that we're monitoring and we're benchmarking and then we're making sure that they're constantly have oversight. And if there's changes, we see that they get changed. And again, taking that responsibility off the plate and liability off the plate of plan sponsors is crucial in today's investment marketplace. Sending that year-end census off from Encompass Group is a huge time saver. It's hours, could be days, depending upon the side of your business, on how to get that information off to your record keeper or administrator. And lastly, I think most importantly, is we sign on as plan administrator on the 5500. That's the ultimate transition of liability to us, of transferring that responsibility of administration. So again, as we mentioned earlier, skin in the game and making sure that all the T's are crossed and the I's are dotted of operationally. So there are things that hopefully you can take away from my discussion today of things that we need to follow up on and do. But right now I'm going to turn this over to Jim Warner of Lean Financial, and we're going to talk a little bit about market updates.
Thank you, Steve. My name is Jim Warner. I'm the Director of Research at Lear Investment Management, a strategic investment partner of VisionPoint. I'm going to take you quickly through three subject areas: a quick market update, our proprietary thinking on the coronavirus, and I'll follow with some thoughts on the economy and how this shapes our view around market risk. As you are all likely well aware, the S&P 500 recently declined 35% from its peak in February. And after a concerted and remarkable set of monetary and fiscal stimulus plans, which includes the CARES Act, the market has rebounded 25%. In spite of this multi-week rally, the market is still down about 18% from all-time highs. The VIX on the top right is a measure of market volatility. 20 is generally considered to be normal volatility, and we have been well above that in recent weeks. In fact, several weeks ago, the VIX surpassed the peak set during the financial crisis. Today, the VIX remains elevated around 40. On the bottom left, the 30-year Treasury reflects all-time low yields. It is striking to see yields well under 2%, as this reflects extremely low inflation expectations for the next 3 decades. Finally, oil remains at all-time record lows, as demand is extremely low and supply remains too high. Next slide, please. For the last few months, we have conducted extensive daily analysis of the coronavirus outbreak and the associated healthcare crisis, as well as the stream of epidemiological findings. We did this for two reasons. One, to prevent from being misled by fake news, and two, to come to our own conclusions on when the global economy will restart. In Europe, which is reflected on this page, we are seeing green shoots as new cases of the virus are declining in nearly all EU countries, as represented by the orange bars. Europe is beginning to make plans to get back to work, and in some countries like the Czech Republic or even Italy, non-essential businesses are reopening. Important to our work was our early hypothesis that who gets the virus is more important than how many. Our early work on Chinese epidemiological data led us to look closely at the age of the patient and the impact of pre-existing conditions. Over time, our hypothesis has proven out that older patients with pre-existing conditions were most at risk of hospitalization and ultimately death. Next slide, please. New data from Italy has put an even finer point on our thesis. With a median mortality age of 80, 61% of patient deaths had 3 or more pre-existing conditions. Or said a different way, 96% of all deaths were of patients with a pre-existing condition. So in other words, the majority of deaths occurred in already very sick elderly patients. In the US, we have seen similar trends pointing to a very specific demographic with heightened risk, as 89% of all patients hospitalized had at least one pre-existing condition. These figures were gathered by the CDC, and as you can see, for hospitalized patients 65 years and older, 94%, or virtually all, had at least one pre-existing condition. The table has a lot of data, but I think it is helpful to list out, actually if we could go back to that slide just for a second. The table has a lot of data, but I think it is helpful to list out those conditions. And the first thing you'll notice is that if you try to add up the occurrences by condition, you'll get a much larger number than 100%, which of course means that many of the patients possessed more than one condition. In short, it should be very easy to identify who is particularly at risk. Next slide, please. Looking more broadly at the entire US, we see new cases have peaked, as reflected in the blue bars in the graph, and the curve is flattening. Given the early adoptions of shelter in place in highly populated states like California and Texas, the virus has been contained. In fact, as of this morning, every single state is now experiencing a decline in new cases each day. The orange bars reflect when symptoms of the positive cases were first noticed. As you can see here, symptom onset precedes the confirmation of the virus and provides a leading indicator of the outbreak. This graph shows that illness onset has plateaued and is likely on the decline. So the debate over when to restart the economy is now in full bloom. To summarize these virus comments, the virus outbreak appears to be contained in both the US and the EU. We know who is most at risk of hospitalization or worse. We also know better therapies will be available soon, with a vaccine perhaps 12 months away. This data and other strategies can now be considered for removing shelter in place and gradually restarting the economy in the coming weeks. We do expect certain states or regions of the US to restart at different speeds, and some level of social distancing will continue to exist for several more months. But nevertheless, there is light at the end of this tunnel. Next slide, please. Shifting our attention to the economy and the market's path to recovery, we are focused on monetary stimulus, fiscal stimulus, and the virus's decline as the necessary 3 legs of this recovery stool. On monetary policy, the Fed has acted swiftly and very boldly to ensure the functioning of the financial markets. With unlimited QE now supporting the vast majority of credit classes, liquidity and another bout of forced selling should be off the table. On fiscal policy, the CARES Act has acted boldly to directly infuse individuals and small businesses with cash through several programs that should help ameliorate some degree of the job and revenue loss during these difficult shelter in place months. We expect Congress to do whatever it takes through program expansion and another stimulus package as necessary. This is an election year after all. Clearly, the virus remains a wild card, but as we've said earlier, its containment is on track. Better therapeutics and testing are or soon to be available, and as we wait another year for a vaccine. Next slide, please. So for now, we are seeing every day the true brutal nature of the economic impact of the lockdowns. Unemployment claims as of this morning now total 22 million in just 4 weeks. This number means that we have erased all of the jobs created during the last decade since the financial crisis. It is a staggering hit to the economy. The bright side, if any, is that we track layoff notices in various states. And in California, for instance, 61% of the layoffs are listed as temporary, which at least indicates a positive intention to rehire. But many other economic indicators are indicating the depth of the recession, from consumer sentiment to housing data to building permits to retail sales. And here even we included the University of Michigan consumer sentiment. And the key question is just how long these lockdowns are in place to determine how much of this damage is temporary versus permanent. Next slide, please. So our current view on the markets is constructive in spite of the near-term economic data. Our core belief, which is perhaps even more important today than ever with extremely low interest rates, is to buy stocks for the long run. We like high quality stocks today trading at a discount to core earnings power. We like businesses that will accelerate in a new normal after we emerge from our lockdowns, which will likely include some form of social distancing, for example, e-commerce and gaming equities. We are avoiding distressed equities in industries that we believe will be fraught with bankruptcies like airlines and hotels. We are watching a few things that could derail the markets in the near term, including the market is a little overconfident at current levels in the shape and speed of the economy's restart, and assuming also that the CARES relief package is adequate, which we really don't know at this point. The VIX also is still well above 20, so we're still in a volatile territory. The virus could, of course, reaccelerate, which would be something of a great concern. And we are beginning to see some signs of social unrest as a result of the lockdowns and resulting humanitarian issues. But the bottom line is, however, is that we are long-term positive on the markets, particularly equities, because the federal government and the Fed are unified in providing both the market and the economy support. And with that, I'll turn it back to Terry to moderate the Q&A.
Great, thank you, Jim. Really, really good information, Jim. We appreciate your insight on the market. Jacinta and Steve, great info. I think we covered a lot of bases today beyond just the CARES Act. So I think this was really beneficial for everyone. Before we start our Q&A session, I just want to let everybody know that if you are interested in learning more about the Encompass Group or our 401k solution, please reach out to us. We will be sending a thank you note tomorrow with the presentation attached. We'll also include our contact information and some other information as well in that email. You can also respond to Encompass Events, which is where you got the invitation originally. So be on the lookout for that. I also want to give everybody a heads up that we will be hosting another webinar next Thursday, April 23rd, where we're going to highlight the advantages of behavioral assessments, reference checking, and video interviewing tools. We will be joined by our partner Outmatch for that webinar. So please keep an eye out early next week for that invitation. So at this time, I'm going to start the Q&A session. Thank you everybody that submitted your questions. I'm going to kind of start in order here, and we'll go through this. Does an employee qualify for a withdrawal or distribution if his or her spouse loses his or her job or has reduced hours, but the employee does not? Jacinta, do you want to take that one?
You bet, and I'll ask Steve to chime in if he disagrees with my response, but I will tell you that this, by and large, has been interpreted by most of our vendor partners as yes. So most of them had said absolutely that qualifies even if the employee themselves was not the one that lost a job or had a reduction in hours. it is still considered an approved event. We have had a couple of our smaller partners come back and raise the question whether or not they agree with that, but by and large, the answer is yes. And I would also add in the end, this is a self-certify situation, so it would fall back on the plan participant to be able to prove that they had experienced adverse financial consequences because of this. Would you agree, Steve?
I'd agree 100%. Yeah, I mean, it does include the spouse because they could be the wage earner, or obviously their income is critical to the finances of the home. So absolutely, I agree that a spousal hardship is sufficient reason to apply for these loans. And again, it's all part of the self-authentication process as well. And so that relieves the plan sponsor from that fiduciary responsibility of approving these, because it's all up to the participant to verify or justify the need for this money. So agree 100%.
Great. Thank you so much, Jacinta and Steve. Appreciate that. We're going to move on to the next question, which is, does partial plan termination need to be handled now or assessed at the end of the plan year? For example, the end of 2020.
I would say with regards to partial plan terminations, it may not need to per se be handled right now, but I think it's definitely something we should be checking into now so that we can ward off any future financial obligation that we may have for forfeitures that may need to be repaid back to employees if you've used them to offset any future match or employer contribution of any sort or plan expense. That's more so why I raised the conversation or the question now is I want you to be able to be adequately prepared for any impact it may have on your organization. And it may take fully until year end for you to even experience a partial plan termination. I simply spoke to the fact that many of our clients are dangerously close or are in a situation of a partial plan termination due to the reduction in force that they've seen so far.
Great. Thank you, Jacinta. Appreciate the response on that. We're going to move on to our next question. Partial plan terminations, is 20% reduction based solely on layoffs, or does it include employees that also quit?
I'm going to start this question with a response of, in our follow-up, Terry, I'd like to include the link to the IRS website that addresses this specific question, because there is a lot of really great information when you start digging into the finite details of partial plan terminations. At the end of the day, it is going to be up to the plan sponsor to prove that an employee was involuntarily left the company, I guess is the words I would look for. So involuntary termination, the proof lies back on the plan sponsor to say that employee left on their own versus this employee was forced out through a reduction in force. So the proof lies back on you. That 20% generally, for the most part, is based off of a reduction in force that is employer initiated.
Okay, great. Thanks, Jacinta. Appreciate that. Steve, I think this next one might be for you. Do all PTAs sign the 5,500?
The answer is no. Matter of fact, most TPAs do not sign the tax return. They'll prepare it on the behalf of the plan sponsor for their review. The plan sponsor would sign it. A lot of TPAs do file it on their behalf, but they do not sign it unless they are engaged and contracted as the 316 plan administrator. And that could be their TPA. It could be an independent firm also, that there's firms that'll sign on and do that as well. But the only time we were not signing on as a TPA, we're signing on as a plan administrator on the 5,500.
Great. Thanks for that clarification, Steve. Our next question might be for you, Jacinta. What type of education does VisionPoint offer to employees?
You bet. We have a pretty, I'd like to say, unique approach to education, as we truly believe education needs to be much more broad than just the 401k. Many times as an industry, we fall prey to just telling employees to save, and you need to save more, and let's talk about how we invest those dollars. But we fail in that approach to address employees who don't save simply because they can't afford it. So our approach is really holistic to their overall financial picture. which can be addressed via recorded videos if clients say that, you know, pulling people off the line, et cetera, is not the best option for them, and they choose to have just customized recorded videos. We can do that. We provide live on-site group meetings. And we also have a really unique program or platform that allows us to do one-on-one meetings with participants virtually through a digital platform that is inclusive of all of their financial information. I don't want to spend too much time going into that, and I'd love to share information with anyone or the participant who asked this question if you want more details about that.
No, that's great. And I can attest just from the Encompass Group and our experience with VisionPoint, our employees, we have like kind of group sessions around education, and then we have one-on-one meetings. And again, to Jacinta's point, it's beyond just 401k, but really financial planning as a whole. They're not there to sell anything, but they're really just to help people with savings and budget and 401k and managing their 401k plan. So all of our employees, and I know other clients of ours have had the same experience where they get like one-on-one consultation from VisionPoint, which is truly invaluable. All right. Well, we actually have gone through all the questions at this point. So I do want to thank Steve Finnegan, Jim Warner, and Jacinta Thompson for joining us today. Thank you for all of the insight that you provided for everybody that attended. Just to confirm to everybody, the SHRM activity ID number is in the bottom left hand of your screen. Jot that down because that will not be part of the copy of the presentation that's distributed tomorrow morning. So Jacinta, Jim, Steve, any closing thoughts?
I just want to thank everybody for their time. We appreciate the opportunity.
Ditto. Thank you very much. I appreciate it.
All right. Thanks, guys. Appreciate it. Everybody have a great day.